Is a stock market crash on the horizon? In this video, we'll explore the signs and signals that could indicate a potential market downturn. From economic indicators to technical analysis, we'll dive into the data to separate fact from fiction and give you a clear understanding of what's really going on in the markets. Whether you're a seasoned investor or just starting out, this video is a must-watch for anyone looking to stay ahead of the curve and protect their investments. So, is a stock market crash ahead? Watch to find out. Join me as I dive into the stock market and try to predict if a crash is really on the horizon. One of the most pressing concerns for investors today is the looming threat of a stock market crash. With market volatility at an all-time high, many are left wondering if we are on the cusp of another catastrophic event that could wipe out their hard-earned savings. Many experts believe a market crash may be imminent, and the signs are clear. Take, for instance, the unprecedented level of debt we're currently seeing in the global economy. The world is drowning in debt, and it's only a matter of time before the bubble bursts. Then there's the tumultuous state of geopolitics, with tensions between major world powers at an all-time high. It's a perfect storm of uncertainty, and uncertainty is what drives markets down. Furthermore, the current bull run has been going strong for over a decade. History tells us that what goes up must come down. And lastly, the yield curve has been flattening, a reliable indicator of an impending recession. The yield curve is just one of many economic indicators that are flashing red. Inflation rates are creeping up, which could lead to a sudden and drastic hike in interest rates, sending shockwaves through the market. And then there's the issue of market sentiment, which is increasingly becoming detached from reality. Many investors are buying stocks based on hype rather than fundamentals, which is a recipe for disaster. As the old saying goes, when everyone is on one side of the boat, it's time to get on the other side. With everyone piling into the market, it's only a matter of time before the music stops and everyone rushes for the exits. But perhaps the most compelling piece of evidence is the eerie similarities between today's market and that of 2007, just before the great financial crisis. The same reckless speculation, the same complacency, and the same hubris that led to the last crash are all on display once again. And if history is any guide, we know how this story ends. The experts are sounding the alarm, from billionaire investors to renowned economists, all warning of an imminent collapse. It's hard to ignore the writing on the wall when so many smart people are telling us the same thing. Economic indicators are essential tools used to assess the overall health and direction of an economy. One of the most significant indicators is gross domestic product, which measures the total value of all goods and services produced within a country. A rising GDP suggests economic growth, while a declining GDP signals a slowdown or potential recession. The unemployment rate is another crucial metric, reflecting the percentage of the labor force that is jobless and actively seeking employment. A high unemployment rate indicates economic distress, whereas a low rate suggests a strong job market. Inflation plays a key role in economic analysis as well, representing the rate at which the general level of prices for goods and services is rising. Controlled inflation is a sign of a stable economy, but excessive inflation can reduce purchasing power and lead to financial instability. Technical analysis is a method used by investors and traders to evaluate and predict future price movements of financial assets. Unlike fundamental analysis, which focuses on economic indicators and company financials, technical analysis examines historical price data, trading volume, and market trends to identify patterns. Moving averages are a common tool in technical analysis, helping traders smooth out price fluctuations to determine the general direction of an asset. Chart patterns such as head and shoulders, double tops, and flag formations provide insights into potential trend reversals or continuations. Momentum indicators, including the relative strength index and moving average convergence-divergence, are also widely used to gauge the strength of a price trend and potential overbought or oversold conditions. Combining economic indicators with technical analysis allows investors to make more informed decisions. A strong economy with rising GDP and low unemployment may support a bullish market trend, reinforcing positive technical signals, such as an upward moving average or a breakout above resistance levels. On the other hand, warning signs such as slowing economic growth, increasing inflation, and a rising unemployment rate may align with bearish technical signals like declining price momentum and breakdowns below support levels. By integrating these two approaches, investors can develop a well-rounded strategy to navigate financial markets effectively. The million-dollar question is, what does this mean for investors? The answer is simple: it means it's time to be cautious. It's time to diversify, to allocate your assets wisely, and to have a plan in place for when the inevitable happens. Because when it does, it will be too late to react. The signs are there, the experts are warning us, and it's up to each and every one of us to take action. For small investors navigating today's economic landscape, staying informed and adaptable is crucial. With global economic growth forecasts being revised downward and inflationary pressures persisting, market volatility is expected. Start by focusing on quality assets with strong fundamentals. In uncertain times, large-cap stocks, dividend-paying companies, and defensive sectors, healthcare, consumer staples, and utilities tend to be more resilient. Avoid chasing speculative trends or high-risk stocks that may collapse in a downturn. Diversification is key to managing risk. Spreading investments across different asset classes, such as stocks, bonds, real estate, and commodities, can help protect your portfolio from extreme fluctuations. Consider exchange-traded funds or index funds that provide broad market exposure with lower risk. Pay attention to both economic indicators and technical signals. If GDP growth slows, inflation remains high, or interest rates rise further, the stock market may experience increased pressure. Monitor unemployment rates and consumer spending trends, as these can impact market sentiment. From a technical perspective, watching moving averages and key support levels can help in timing your investments. Maintain a long-term perspective. Market downturns are inevitable, but history shows that recoveries follow. Dollar cost averaging, investing a fixed amount regularly, helps smooth out volatility and reduces the risk of making poor timing decisions. If a stock or sector drops due to short-term fears but has strong long-term potential, consider it an opportunity rather than a setback. Finally, keep emotions in check. Fear and greed drive market movements, but successful investors remain disciplined. Avoid panic selling during market drops and resist the temptation to overinvest when prices surge. Having a well-thought-out plan and sticking to it will position you for long-term success, regardless of short-term fluctuations. The stock market is always unpredictable, but history reveals patterns that repeat over time. Economic cycles follow a familiar path, moving from growth to contraction, fueled by factors like interest rates, inflation, and investor sentiment. Market euphoria often signals the beginning of the end. When stocks soar beyond fundamental value and speculation drives prices, a downturn becomes inevitable. Crashes don't happen without warning. Rising debt, economic slowdowns, and tightening monetary policies create the perfect storm for a collapse. Corrections are natural and necessary for long-term stability. Investors who understand this cycle position themselves for opportunities rather than panic. The key to surviving a crash is not predicting when it will happen but preparing for its certainty. So what do you think? Do you think a stock market crash is imminent, or are the experts just crying wolf? Let me know in the comments below, and if you're new here, consider subscribing for more investment-related content.